Welcome to Indianomics. The threat of tariffs has been larger than the actual tariffs. President Trump has announced 25 to 50% tariffs on about 15 countries this week, but via letters, not executive orders. His executive order has actually pushed the effective date of higher tariffs to August 1, as we know. Now, that explains why markets have not reacted very badly to these very large tariffs that he has announced via letters. And then there is this threat to the BRICS countries that they'll be hit by 10%. There's also a threat for those buying crude from Russia. There is threat on pharmaceuticals. As of now, it appears that the world may have to live with 10% tariffs for all imports into the US, 50% tariffs on steel and aluminium, and a whole lot of threats. Now, what's going to be the upshot for EM economies, for the US itself, and for rates and currency markets? I have with me Chetan Ahya, the Chief Asia Economist at Morgan Stanley, Kuijs, Chief Economist, Asia Pacific at S&P Global Ratings, and Goel, Global Head of Emerging Markets and APAC Research at Deutsche Bank. Gentlemen, thank you very much indeed for your time for what must be very busy days for all of you. Louis, let me start with you. If this is the status quo that we should get used to, about 10% to 15% imports and a whole lot of threats, what will it mean for the Asia-Pacific region? Should we be prepared for even lower growth?
Well, Latha, I think it's clear that both the elevated level of the US tariffs, but also the uncertainty around it that you indicated, is not helpful if you're thinking about where to expand, where to build factories, where to export to. So we expect this to weigh over the region, especially the more export-oriented economies, of which there are quite a number, of course, in the APAC region.
Yes, the uncertainty and therefore the problem with investments, problem for investors. Samir, what about the impact on the US itself? The latest numbers we saw didn't look all that bad. I mean, even if you looked at inflation, it was not way higher, it was higher enough for for the markets to remove the expectation of any cut anytime soon. Do you think the tariffs are going to show by way of higher inflation in the US sometime soon and therefore prevent the Fed from any rate cuts at all this year?
Hi, morning, Latha. No, so indeed, I think one of the interesting facts about data has been the US economy has proven to be a lot more resilient, even to all this level of unpredictability and the threat of higher tariffs. Now, part of the story could well be front loading. I mean, everybody is fearing those tariffs to go up and therefore exporting rather rapidly to the US. I think it's keeping up sort of general activity levels a lot better. But it is true. I think this high uncertainty around the tariff policy, we suspect will bear down on growth in the second half. Part of the equation has also been how easy financial conditions have been. The financial conditions in the US are right now easier than they have been since sort of early 22, and which has probably been part of why this resilience come about. The consumer balance sheets fairly clean, firm capex plans. Yes, I think sentiment has been weakening, but nowhere near about as large as one would have expected, given how big a shock to the global trade order the last few months have actually proven to be. Still, it's on watch. I suspect second half there will be payback to that front loading and a lot of trade activity. Our view in the House is that growth will slow down. I think we will avoid recession, but growth will slow down in the US. Now, as far as the Fed is concerned, our view is they'll probably only be cutting rates by December of this year. Risks are maybe more two-sided, but I argue it will require probably a lot weaker labor markets for the Fed to trigger rate cuts earlier than that.
Okay, then let me just finish the Indian or the Asian situation. We have never seen this kind of rate differential between India and the US. What does that mean for the Indian currency? Do you think that there could be appreciation bias on Asian currencies in general and India?
So I think there's a little bit of a difference. I think India has a bit of a unique position within Asia. So like you said, there's a common factor, which is the rate differential. And absolutely, the rate differential argues a lot more in favor of the US at the moment. I mean, the differential is fairly wide, and on top of it, given how low inflation is in bulk of Asia, including India, the bias should be for, in a way, that differential to at least sustain at these levels, maybe even widen, depending upon how quickly central banks in Asia actually cut rates. The other factor, though, besides rate differential, which is driving, in my view, the currency markets, is, of course, this sort of lessening appeal, the safe haven appeal, if you might, of the dollar, or the willingness of the rest of the world to be able to invest in US assets or recalibrate the exposure they have towards the dollar. And that's something which I think is far more better looked at from the metric of net international investment position. Now, that's where India differs a lot. A lot of Asia is surplus on its NIIP. India isn't necessarily, so it doesn't necessarily benefit from the same factors. But for a lot of the rest of Asia, I'd say the fact that the investment community is not willing to necessarily at least incrementally add to its dollar exposure and probably willing to convert a larger part of its dollar stock holdings into local currency itself lends more of an appreciation bias. I think India is a bit of an exception on that front, but certainly for rest of Asia currencies, our bias is to think for more strength in the second half of the year. Okay,
more strength for other Asian currencies. Rupee perhaps will move both ways. I'll come to your view on the dollar itself in just a minute. Chetan Ahya has joined in. Welcome to the show, Chetan. Well, I wanted to begin at the beginning. You know, as we explained at the start, we are living with 10% import tariffs for the US and 50% for steel and aluminium. But the rest is a whole lot of threats. Nothing has been implemented just yet. What does this mean for EMs? Does it mean that you can actually push up your growth forecasts or no?
Well, not really. I think, Latha, I think not only this the new announcement, but the ones which were announced earlier are also still not yet reflected in the growth data points that we are watching across the region. The reason why there is a lag is because when you think about the tariff impact, so the tariff impact has also been delayed because stuff that gets imported into the US, if it is shipped on a particular date, which is right before the tariff is imposed, it does not attract that tariff on the US shores. And so there is, if you look at the US customs data, weighted average tariff in the US has increased to approximately 10%. But when we do the actual math of what is the weighted average tariff rate based on what were the import values last year, and then what is the tariff imposed on different countries, and that number is 13.5%. So tariff itself has got delayed in terms of actual collection because of the way the accounting is done. Plus, you have the other challenge, which is that, you know, corporate sector has taken a decision not to invest in future projects, or if they have taken that decision not to invest in the future projects, that impact also takes time to come through in the numbers, because right now we are still implementing the projects which were announced earlier. And so the investor base has suddenly got that sort of sense that, oh, tariff doesn't impact US inflation, tariff doesn't impact corporate margins, tariff is not going to be an issue as far as the CapEx decision is concerned. We don't agree with that. We think all of this impact is in the pipeline, and we're going to begin to see that from the third quarter of this year. And for Asia specifically, we are saying that, you know, the CapEx numbers for July, August, which we will be measuring very clearly from the capital goods imports data, which is a high frequency number. And that's what will actually come through. So, and the new announcements are only going to make this whole downtrend that we are building in either more confirmed, or you'll probably see more downside out of additional tariffs.
Okay. Well, I have a lot of questions on then EM growth for you. But, you know, specifically with respect to India, Chetan, see, the big expectation is that we will not be taxed as much as, say, Vietnam or Bangladesh, that we would be, you know, taxed less. Probably we already have a 10%, maybe it would become 15 or 20. Will your forecast of India's growth be very different from what it is now, if it is indeed 15 or 20? Let's work with those numbers.
Look, I think the biggest impact that we have been referring to is the point on global trade and global CapEx. and consequently also India's capex trajectory. And that part of the impact is more connected to this uncertainty that has been created on account of tariffs, which is going to remain. I mean, if the global trajectory gets affected more because of the new tariffs, and therefore India's exports or also Indian corporations' confidence on their export demand outlook, that part is sort of independent of what tariff specifically is imposed on India. I think if that higher tariff is imposed on India, then it takes away that offsetting demand which we would have expected India to get through, because India's tariff is less, other Asian trade partners' tariff is higher. Then you could have said that the exporters in India would benefit and they would have market share. So that's the only bit which will be sort of taken away if India's tariff rate is similar to other regional players. Like we've heard Vietnam's number at 20, and if India's number is 15, then that gap narrows and it reduces that market share gain potential that Indian exporters would have had.
So what you're saying is that it's a very small needle that moves if India is indeed able to strike a deal at 15, because in any case, the rest of the world will slow because of the uncertainty and, the higher tariffs that the others are suffering, correct?
Yeah, if I may summarize it better, it's a global beta effect, and there is also an alpha story, right?
Yeah.
So that alpha story is a small proportion. I think the beta is a bigger, important story. If there's a global slowdown, global exports slow, then it will be hard for India to avoid that downturn.
Okay. Louis, a similar question to you, actually. Where are you all in terms of, pitching the growth story in Asia in general, but more particularly for me, India? Will the deal make a very big difference to your estimate of Indian growth?
Well, so these are almost two different stories, right? The general EM-Asia story and the India story.
Okay.
Our India story is also, of course, picking up the fact that after a soft patch last year, the recent data on India has been better, so we have become a bit more optimistic on the domestic side. And in an economy like India that is so large and where the domestic side is so important, that really matters. And so I would say, I think if I recollect correctly, our latest change to the India forecast was moving up because of that better domestic momentum. That having said that, more generally, our story on EM-Asia, and that kind of includes India, has from the start been like we should not underestimate the impact of those US tariffs and all that uncertainty that my fellow speakers have also talked about, how that is weighing on investment decisions and economic activity. And so we've generally been a little bit less optimistic, if I use the word. I've heard quite a few economists talking in recent years about looking who are going to be the winners in Asia, the countries that will benefit as supply chains are shifting. We have been a bit cautious on that. We have felt that given all that uncertainty, and if your neighbor's tariff is 20% and yours is 15%, is that really going to drive an investment decision that is based on many other factors as well? So we've been quite careful, and we've also been noticing that actually, if you look since the first Trump administration of quite a while ago, overall FDI into Asia in US dollar terms has come down rather than up. And so I think the general story is not really a good one. And trying to find relative winners is, I think, not the most important or not the most worthwhile effort. Generally speaking,
I get your point. You're basically saying what Chetan put it as, the global beta is more important and the alpha is for India will be, lower. I take your point.
But I would say, Latha, like the global story is important, but Asia is a relatively trade-dependent part of the world, right? And so that's why we have become particularly less bullish on the smaller open economies, be they Thailand, South Korea, these types of places.
Fair point. And maybe that's the blessing for India. But Samir, I want to get to the dollar. You brought a very important point to the table that large parts, many countries in Asia are not interested anymore in, buying US assets, especially US treasuries. Now, where do you see the dollar, therefore? There is the big, beautiful bill, and there is the demand side as well. Supply also is against US yields. There'll be too much of it. And there is less demand. So your trajectory for dollar and US yields?
Latha, from my perspective, I think it's very hard to be bullish on the dollar at this point in time, right? I mean, first and foremost, I mean, the twin deficits are bearing down on the dollar fairly significantly. We are probably running a current account in the US is, I would argue, probably close to 4 to 5%. This tariff policy hasn't really made much of a difference, though obviously there is a front-loading impact and we need to see payback to that. But at these levels of the current account in the past, the dollar has been materially weaker over a 1 to 2 year period. The other way to look at it is, of course, increasing pressure on the Fed to also ease policy, which could ultimately also take away that rate differential support, which you were earlier speaking about. But probably what is most critical, I'd say, is the fact that ultimately the global appetite to invest in the dollar is just a mirror image of the trade gap the dollar runs with, the US runs with the rest of the world. And to that extent, a shock to the global trade order will eventually also result, as it has been for the last couple of months, on the rest of the world's appetite to own US assets and to be able to fund that US deficit. Now, the US is sitting on a net international investment position which is negative to about 80-90% of GDP. Even if that were to try and revert back to some level of historical norm of about, let's say, 60%, that would still require potentially material dollar weakness from here. Now, the dollar obviously has that safe haven exceptionalism, so it's hard to be able to look at just historical trends to see how much that correction would be. But it's not obvious to me at all that, particularly with the current set of policies, that the global appetite for the safe haven appeal of the dollar is necessarily going to lend to the same level of financing of deficits.
I will have to stop you for a moment because we have to take a commercial break. But coming back with more specific, requests for growth targets as well as currency and yield targets. Back in a minute for Bazaar viewers, of course, it will be Chartbusters time.